My name's Craig Starr. Everyone knows Jay Hatfield, of course. Then our special guest today is Will Barton, who's the lead analyst for High Dividend Opportunities Investment Service, which was founded by Rita Morwa, and they are the largest following on Seeking Alpha. So please feel free to type in your questions, and Will and Jay will answer them as they get to them. Thank you. And as a reminder, the presentation and the replay will be sent out to everyone afterwards. Thank you.
Great. Thanks, Craig. And thanks for everyone for joining. And thanks to Will. I think you'll find that his service, which is the leading service on SA for dividends, is a great complement to the information we put out, because we, of course, just focus on our funds, and Will's much more focused on building a high dividend portfolio, so very complementary. This is the most important slide, which demonstrates what is not the view from our office. So very critical slide. But I don't know where that view is. I think the GM building maybe, but that's not where we have our office. Just because there's probably some new people on the call, just a quick overview of our funds. We have 6 income ETFs, and we do have a hedge fund that we recently opened up for high net worth investor or accredited investors, which we won't talk a lot about, but welcome to contact us and ask about it. So these are our 3 fixed income portfolios, and it's of course critical to distinguish between fixed income and equity income, because a lot of times people say, well, what's going to do better? Your fixed income, is PFFA going to beat ICAP and SCAP? The answer is, well, one's fixed income, the other's equity income. So I hope the equities, because they're more risk, more correlated with the market, that they would do better than the fixed income. You do fixed income because you want more security, you're senior to common, you have some market risk or stock market risk, like 0.4, 0.5, but really good income. So they're different asset classes. We think it's important to have both. So BNDS is our high yield fund. These are the SEC yields, which are good to look at, but the distribution yield's a little bit higher, like close to 8. PFFA is right on top of this 9. And then PFFR, well, BNDS has no leverage, PFFA about 20%, PFFR no leverage. So 3 good flavors, all of them have performed well. You can check that, all returns you should check on our website. But 3 great ways to add income to your portfolio with low market risk. And then we have the 3 equity income funds. AMZA, great after-tax returns. It is a lot of, some people have been contacting me and frustrated with the returns of AMZA. It's important to note that this asset class, it was super risky in the past. It's really become defensive as a beta of 0.6, so a beta close to fixed income. So if you really want to participate in the market rally, then you should buy AMD and not AMZA. If you want more like fixed income type risk and return, although it should be higher than fixed income, should be low teens. Eventually it'll get some play, like Energy Transfer announced a deal to provide power to a data center. So there is a data center story. Nobody seems to care right now. But think of it a little bit more like a hybrid between fixed income, equity income. ICAP's been doing extremely well. I love this fund. We write short-term calls on large cap stocks, great business. It's been very competitive, beating its index and even competitive with, or actually beating the equal weight S&P. And SCAP's timely. Small caps do well when interest rates are dropping, not because they're over levered, but because of the sectors they're in. There's less tech and more interest rate sensitive sectors like financials and just higher risk. Small cap stocks are high risk, so tend to outperform in markets like this. So we think a good asset class, and probably one of the few ways to get really high quality companies that produce good income. We do write not individual calls there because you don't want to cap your return on small caps because they can be acquired. And when they beat earnings, they go up 30%. It's not true of large caps. So just a quick overview of our funds. And these are all the SEC. You see that we don't, like Will, believe in high levels of income, not like 2% or 3%, but high levels of income. And then this is where we really have differentiated ourselves, is with our macro calls, not just on the economy, but stock market, bond market. We've been nearly perfect historically, no guarantees going forward. But the core of our advantage, which is a big advantage over the Fed, because they don't look at the money supply at all, which is, I was retweeted by the president, is like the Pope not believing in Jesus. So our key advantage, we look at the money supply. You know, I wrote my master's thesis at Wharton on this and studied under a monetary economist 45 short years ago at UC Davis. Should not ignore monetary policy like the Fed does, so you don't become an incompetent forecaster. So the monetary base is the critical indicator. It's been flat. So we've been appropriately bullish about inflation, particularly if you calculate it properly. And a lot of clients or other people or people on television say, oh, well, I'm worried that inflation is going to spike. That just doesn't happen. If the money supply is not growing excessively, you don't have spikes in inflation, except there's one exception. Oil prices can spike. That they went up 1,200% during the 70s. That's what gives rise to stagflation. And of course, oil prices are down, so it's deflationary. But keep in mind, during the 70s, we had wage and price controls. So US producers made like $10 when the market price was 40. And that caused a collapse in US production. So hopefully we don't have wage and price controls, and we therefore have pretty stable energy prices. So we're bullish about inflation. Therefore, we're bullish about Fed rate cuts. That's extremely bullish for both bonds and stocks. And we've been spot on. We had a 6,600 target. We kept that when the market was at 5,000, unlike most strategists. And we recently raised that target to 7,000, and we have a 7,700 target next year. All this supported by our views on inflation and the Fed. You need low rates, like in the 4% range, to support high multiples. The other thing that one needs to watch to monitor the impacts of the money supply is, of course, rates. They have direct impact. We'll have a slide on that. And then the main transmission mechanism or effect of monetary policies on the housing sector. So we have this thing that's meant to be kind of amusing, but people take it more seriously than they should. But we call it the Hatfield rule. Everybody, it's a free country, you can make up your own recession rule, by the way. There's something called the Psalm rule. We don't think that's very interesting because it's an employment-based indicator. It's a lagging indicator. Housing's a leading indicator. And by the way, you can use housing as a leading indicator of inflation. So if the Fed was not incompetent, they would have realized when housing prices were growing at 20% year over year in early 21, that's a huge inflation indicator. They didn't seem to care. Big mistake. And then recently, the housing market has started to go towards our 1.1 million or 8K, the Hatfield rule. So that's a big risk. But the only financial condition you should really look at, not conditions, but condition, is 30-year mortgage, dropped from over 7 to 630. So we think housing starts stabilize, start to grow, and we'll have 3% growth next year. And we are bullish about the budget deficit. There's a lot of misinformation put out for political reasons that the deficit was going to explode and because of the OBBA. But if you look at it properly, which is to look at what it did incrementally, not what it did relative to 8 years ago when it was originally passed, when the original tax cut was passed, it really is mildly fiscally conservative, very mildly. So, but the CBO is projecting 1.9 trillion this year, 1.7, but they ignore tariffs. So we're projecting 1.3, mild tailwind for rates, which is critical if you invest in yield securities, of course. And then stock market, we talked about this. Raised our target to 7,000. That's 23 times next year's earnings, which is historically a pretty full multiple, but not a bubble. Supported if we have low rates. If rates go to 5, it would not be supported. And it's supported by better than expected growth, particularly from AI companies. Next year, so this would be the end of 26 targets based on 27 earnings. Not an aggressive target. Same multiple, 23 times the following year's earnings. Next year's 26 earnings for the S&P is about 305. Following year is about 350. And so not an aggressive target, but it does require rates to stay low. We do think they will stay low if the Fed stays on track. And as I mentioned, we're bullish on bonds. We thought rates would go into the 3.5 to 4. They did briefly. Right now, they're probably stalled. We have a chart on this at 100 over the terminal rate on Fed funds, which is currently expected to be 310. That might drop if we continue to get good inflation data. And keep in mind, inflation data over the last 5 months is annualized at about 2%. CPI-R, so that's marking to market, is well below 2. So inflation's already solved. The Fed doesn't know this, but it is already not a problem. And these are just, we've improved our charts. I'll finish these up quickly and let Will talk. But you can see how this is why you have to follow not just money supply and interest rates, mortgage rates really, but also housing. Housing's caused 12 out of 13 post-World War II recessions. The one it didn't cause was 2001, very mild recession caused by the tech bust. And we have a great slide coming up. Don't worry about the consumer. The consumer is not volatile, so it doesn't impact recessions. Here you can see, so investment is sluggish, only up by 1.57%. It's pretty sluggish, but it's slowed by structures being negative year over year. So in a recession, residential being in a recession, which makes sense because rates are super high, yield curves significantly inverted, and we're well above the likely 3% long-term rate on Fed funds. But the economy is being supported by IP, which is obviously tech and spending, and equipment, which is chips and data centers, and also electricity production equipment. So that's why we don't think we're in a recession. And if the Fed keeps cutting, long-term rates will stay low, housing market will improve. So we're sluggish growth this year, like 1 to 2, maybe a little bit better than that. 3% next year, great tailwind for stock market. Here's the great chart. So everybody's always stressing about the consumer. Consumers never caused a recession. What happens is investment plunges, and mostly because of housing. But in September of 2001, that was all driven by tech. So investment plunges, there's layoffs, then there's a little bit less spending, but not much, and you have recession. So it's important. It seems like nobody knows this, even though this is very obvious data, but nobody seems to really know this. And this is just another way of charting it, but just to show it's investment, this doesn't have consumption, but the prior chart debunks the consumption assumption, I guess. If you're worried about inflation, you can see our real-time inflation leads CPI-U or regular inflation. So don't be concerned about inflation. Eventually, we'll get a Fed that actually can adjust this data like we do. And this is what I was always talking about. Don't be worried about the budget deficit and this and that. Rates are driven almost exclusively by Fed funds. 10-year trades 100 over, normally 100 over Fed funds, but also 100 over the terminal rate, which is exactly what it's doing now. So Long-term rates are determined by short-term rates. The Fed will argue to the contrary. It's not true. So don't stress about the budget deficit. Likely to get better, but it's not the key driver of interest rates. And it's just another graphic that shows, this 100 over works really well to predict rates. And if you're worried about inflation, money supply is negative. That's actually a big risk for the economy. But this should tick up as the Fed cuts rates, because to cut rates, you have to increase the money supply. Most people also don't understand that, strangely. And this is just disclosure. All returns, no matter what I say, you should source these on the website to get the exact returns. But I would assert that our returns have been beating the indices pretty substantially. And so that should take us to your presentation, Will. So I'll try to follow along as a moderately incompetent manager of slides.
All right. Well, thanks for having me here, Jay. I really appreciate it. I've been writing on Seeking Alpha for, about 9 years now. And I've been working with HDO since 2019. Rita was reading my writing and said, "Hey, I like this guy. I want you to come on board with me." So now I'm working as the lead analyst for HDO. We've produced an awful lot of content on Seeking Alpha. And our main goal is to generate a portfolio that's producing 8 to 10% current yield. That's a range that allows investors to convert the large lump sum of capital that they've made into an actual living income that they can draw on for the rest of their lives, and hopefully have plenty left over for their beneficiaries in the future. And so you can find us at incomemethod.com. You can find us on Seeking Alpha, which is where we publish most of our articles. We offer a lot of free content, as well as a premium service that really gets in depth. We provide a lot of regular content like earnings reports, weekly updates. We provide an overall market outlook for where we think the macroeconomy is going. And it all comes back to looking at our main goal of getting your portfolio to generate 8 to 10% yields on a consistent basis, and keep that income growing. And so on the next slide here, we have our general breakdown of what we target with our portfolio. We're not looking to predict what the market's going to do in the future. We're looking to set up a portfolio that's going to be all weather. It's going to keep producing dividends through recessions. It's going to keep producing dividends for you in the bull times and everything in between. And we do that by breaking our portfolio into 3 basic sections. You've got the fixed income that includes, preferred stocks, baby bonds, traditional bonds. We have our high yield funds that will include some fixed income funds, but we also have other funds that will follow certain sectors like REITs or commodities. We have a few that just generally track the S&P 500, making sure that we're getting a nice diverse array of sources that are providing you a stable income, regardless of sectors doing good today. For our individual stocks, that's where we find ourselves a lot in areas like BDCs, business development companies, real estate investment trusts, mortgage REITs in particular are really good right now. MLPs, basically companies that are structured in a way that they're designed to produce an awful lot of cash flow, and they can produce a lot of cash flow in a wide variety of economic conditions. On the next slide here, we're going to talk about where we see some of the best opportunities right now. Like Jay was talking about, interest rates have been high for a long time. Inflation was the main driver, inspiration for the Fed to hike them up that high. And ultimately, what is an interest rate? An interest rate is what a company is paying on debt. And who benefits from that? The people like us who are buying debt, the ones who are buying preferred equities. These are investments that are very interest rate sensitive. And do you want to be the one paying it, or do you want to be the one receiving it? And really, for the past I'd say 2.5, maybe 3 years, we've kind of been a broken record pounding the table on buy fixed income because these interest rates are not normal. We're getting much higher rates than we can expect to see 5, 10, 15 years into the future. And it's a great opportunity for us to be buying right now. We've seen over the past year, a lot of fixed income has started coming up in price a little bit. And so when you're looking at going, oh, well, I missed the buying opportunity, not really. Interest rates are still high. There are still a lot of opportunities out there in the market. And that's what we're focused on, identifying and buying them up before suddenly we get back to fixed income being 6, 7% yields. And then we have to turn our attention more to the equities and taking on the greater risk. So on the next slide here, we'll get a little bit more specific about where we kind of see the sweet spot. We've seen the high rated credits, they've been recovering fastest, right? People rush into safety. Then you have the low rated credits where people are really distressed, and you get those situations that have more than a few little warts on them. And two things you want to think about with fixed income. You want to think about what rate am I getting paid? And what are the odds that the borrower is actually going to be able to pay me as agreed? The investment grade label tends to be that sweet spot where all of a sudden it starts getting included in a lot more funds. It's getting bought up a lot more. You're paying a premium for that. If you step down one rung lower, you get into that B plus range. All of a sudden, the investment grade funds don't want to touch them. People call it, quote, junk debt. And that's kind of that range where they still have fairly solid balance sheets. They're still a viable company. They're not super distressed. And you can get those higher yields. And I would also lump some unrated preferred in there. A lot of preferred shares, especially when you're looking at areas like REITs and stuff, they don't bother getting them rated at all. And you can go in there and you can look at the credit quality of the balance sheets themselves. And I think this is right now a very unique opportunity because back in 2020, there was a huge shock for a lot of companies. A lot of companies saw their revenues collapse. A lot of companies saw a lot of balance sheet stress. And you really have 3 buckets of companies. You have the super strong A-rated credits that are fine no matter what. You have the companies that were exposed as being very weak. Their credit dropped down. They became very distressed. They started having trouble paying the bills. And then you have this in the middle crowd that was, maybe they were pushing the line on leverage a little bit too far, but it forced them to rein it in. It forced them to look at their balance sheet and say, okay, we need to deleverage. We need to reduce our debt. And so a lot of them went through that process of doing that. And then when they got to the point where business was starting to grow again, well, now interest rates are skyrocketing. Now it's expensive. And so they really pulled back their horns a little bit. And we don't have that euphoria that you often see, like we saw in 2006, 2007, going into the great financial crisis, where debt is king and we're all going to borrow and borrow and borrow because everything is going to go up indefinitely, right? We didn't have that phase in there because companies went from, we need to protect our balance sheet, to, oh, wow, rates are 300 points higher. It's, let's just hold off on borrowing for now and see if we can get it cheaper later. And so I think that mid-range where you're in that B plus right now is where you can find a lot of opportunities that are still trading below par, but you're not taking on excessive credit risk. We've had a few opportunities that have worked out very well for us recently that kind of went through that scare period. TDS Preferred, that's a company that's in telecom. There was a scare last year where they were worried about the lead around the old copper lines, and all the telecom sold off, and everybody was afraid that they were going to have this big legal bill. And the TDS Preferred were trading at like $10, $15. Now they're trading back up in the low 20s, which is really where they should be. And so we look for those kinds of opportunities where there's excessive fear, people are a little bit paranoid, or other opportunities. Like right now, one of my favorites, AGNC and Annaly Capital, are two mortgage REITs that invest in agency mortgages. And agency mortgages are extremely liquid asset. They finance them with secured financing, and they don't really have any corporate level debt. It's all asset specific debt. They have lots of unencumbered assets, and they just issued preferred that are yielding right now over 8.6%. It's a very comfortable balance sheet to be investing in. They have very liquid assets that they can change things around very quickly. And it's agency MBS, which is an asset that's tied primarily to US Treasuries. They have some floating rate preferred out there that are paying higher right now. And I think that's kind of what forced them to issue at such high yields. But as interest rates come down, suddenly those floating rates don't look so attractive anymore. And being in that fixed rate and getting that kind of yield from a company with balance sheets that strong, it's just a gift. And it's in the market right now. How long will it last? Well, we have one rate cut so far. We're probably going to have two more this year, barring any radical changes in the economy. And so that's really what we're focused on right now. Is we're coming down to the end of this great buying opportunity that we have in fixed income. And we want to focus in on finding the areas that the market is kind of leaving behind and buy them while the buying's good. Then when we're in a 0% interest world again, work gets a little bit tougher, and we'll have to start looking at the common equities and start expanding into those areas a little bit more aggressively. So that's really what we're focused on today. I think we probably have maybe another 6 months to a year of let's keep buying up this fixed income. And whether the economy goes up, down, in between, whatever it does, we're getting a very solid yield. We think we're dealing with balance sheets that are very solid, and we're going to be able to navigate through potential recession if that happens. And if it doesn't, then our investments are just that much safer. So that's what we're really focused on getting done today.
Okay. So I'll just leave it on this insanely detailed disclosures. And it looks like we have a lot of good questions. And I guess not surprisingly, we have similar approach as well. So probably we can both answer a lot of these questions. Ironically, somebody's asking about UZD, UZE, and UZF, which are also in the TDS complex. TDS is one of our biggest holdings. We are selling it off slowly because it's gotten pretty close to fair value. UZD, E, and F were interesting because we had gotten out of them. We owned them because we thought they were way too cheap. Then it was announced that T-Mobile was going to buy a good portion of the assets of US Cellular and going to tender for these bonds. We didn't even own any at that time. But strangely, PFF did not tender for them. That's the big index fund. Then they dumped all of their bonds, and we bought some at pretty good prices. Now they're trading higher. So we still like them. They're good credit or great credit, really, because there's even more spectrum cells coming. But they're also slowly trading up. We didn't buy a ton because they're pretty illiquid because they got mostly tendered for. But we like those, and we like TDS, but they're just getting closer to fair value. I don't know if you have any opinions, Will, on UCD, E, and F.
Yeah, I mean, I would tend to agree with what you said. TDS was one of those opportunities that it came, we took advantage of it. We're kind of in the holding period right now. We are a service that really focuses on buying and holding long-term, right? Especially when we're dealing with these more illiquid investments. When we buy a preferred, our intention is to hold it until the company wants it back. And so we're kind of in that zone where it's kind of right around our buy under price. But that's an example of the type of situation that we try to look for. We buy it when it comes up, and then we'll hold it, and we're content to just let it sit there and keep paying us dividends. If they want to leave it outstanding for the next 10 years, wonderful. If interest rates keep going down, eventually they'll be trading back around par, right? Right now, I think it's at a point where the market has accepted that the risk has been reduced, and now it's just pure interest rates. It's just a question that interest rates are higher now than when those were issued, even though the risk is about the same as they were when they were issued. And that'll come down over time. So that's kind of where we are with that right now. And I prefer the preferred of TDS simply because they're perpetual and they've always had a little bit higher yield than the bonds that were with US Cellular. But I mean, obviously people who have the bonds with US Cellular and now the ones that are being transferred over to T-Mobile, it's definitely credit positive, right? So good for those who grabbed those. I didn't.
Okay, we have two questions that are kind of related, which we can both tackle. Tony said, how do you assess possible private credit crisis for brands? So we think there's been a massive overreaction to this First Brands bankruptcy. Keep in mind, this is an auto dealer. A lot of their obligations were in secured financing, so trade type. So those are get done by CLOs, and I guess Jeffries had some financings there. I don't think there's any significant exposure to private credit, but there's a massive freak out going on in private credit. And somebody probably watched me on Fox Business yesterday because I was recommending APO and KKR. And we don't think that there's a material impact on their portfolios. And I would point out, this is the beauty of other people's money. So if there is a problem, it's not their direct loss. It's not good for their funds, obviously, but it's certainly not worthy of this big sell-off. And so we have kind of almost, they seem sort of ridiculous targets, but we think we'll get there. So APO, we have a target well over 200, which does seem ridiculous, 82% upside. And KKR, these are I'm looking at our official, we have a target of 200. But we think these are really reasonable, 60% upside. We think this is just a complete freak out. And do you have a catalyst? Because believe me, these have not been good stocks to hold. They go down every day. But they're going to have earnings reports, and they're going to tell you if there's any losses, and they're going to tell you probably they have good earnings, and everything's fine. So that's why earnings season's a good time. And you might say all these things, your targets are insane, but we also pointed out on Fox Business, and we've been recommending Goldman Sachs and Morgan Stanley for like 2 years. And those are up like 110%. Still like them, but their upside is like 8 or 9%. So we think there's massive freak out. The economy's getting stronger, so there's not going to be substantial defaults. Good time to be in credit, as well pointed out. Do you have thoughts on First Brands or any of the private equity?
We actually have a little bit of exposure to that because we own some PSEC bonds, and they're one of the BDCs that has, it's like 1% exposure to it. Yeah, it's one of their larger positions. And they have the first lien debt, and that they're obviously potentially facing a loss with that. But I would say that we've kind of seen these situations start popping up in the past year or two where, there's some questionable, possibly criminal fraud going on, where they're using multiple assets and leveraging against them multiple times. And this is something that we often start seeing when the economy slows down. It happens, right? You can go back in time and think of all the times that it's happened in the past, where you have the Enron effect of dishonesty and people using that to over leverage and get themselves into trouble. Happened during the housing crisis all over. That's Bernie Madoff was great until 2009 proved what he was, right? And that's we're going to start seeing those things when the economy gets weaker. It's going to happen. It's not unusual, and that's the kind of credit losses that companies are going to absorb. Something like PSEC is 1% going to kill them? No, it's not the biggest challenge on their company, and it certainly isn't going to get to the level where it's going to start impacting the bonds and stuff. Same thing with CLOs. I can't remember the number right off the top of my head, but all their CLOs they have are broken up into like 517 different CLOs. So any particular company usually doesn't have a big, huge piece of it. So you get this big headline of, oh my God, it's this much money, but it's spread among so many so many lenders that for most lenders, it's not material at all. And defaults are going to rise. For 2021 through 2024, we saw almost nothing defaulting, and defaults were historically low. You get spoiled by that. It's nice to have, but when defaults are essentially zero, they're the only way for them to go is up. Our base case is that for the companies that are being honest, their balance sheets are in much stronger shape than we typically see in a slowing economy. And the big numbers, when you're looking at the grand scheme, I think we're looking at a very, very small default wave compared to what we've seen historically, like during the great financial crisis and even during the dot-com bust and during COVID. I think we're set up for a relatively mild. There's going to be those dramatic stories that are going to come out because the people who have been out there committing fraud, who have been pushing the edge, who have been doing things in the shadows, well, they're going to get caught. We'll see some of that happening and it'll be all right. Lenders know that happens. It's built into the interest rate. And that's why we charge an interest rate. Make sure that you're getting paid enough to justify whatever risk you're taking of a loss, whether that's from bad luck, incompetent management, or fraud, or whatever other reason that they don't pay back.
Okay. Thoughts on banks and financials? We had loved the investment banks. That's pretty well appreciated now, so they're close to our targets. We think that regular banks, so regional banks, there was a big merger, Comerica got bought out. They're going to do well. And I already mentioned there's this particular opportunity with private equity firms like KKR and more credit-oriented firms like APO. So we do like/love financials. We think it's better to be more out on the risk curve. Financials are a very risky asset class, so we're positive on financials. And as Will is pointing out, we don't think there's going to be some bankruptcies, but they're not going to be material and they're well reserved for. Do you have any thoughts on banks and financials, Will?
We've been kind of at the edges of that. I'm not a huge fan of banks in general because banks are designed to protect depositors, right? That's just how the regulations are. Depositors first, and you can have those very sudden, unexpected bank runs that you can't really account for, like Silicon Valley Bank, right? Everybody thought that was a premium credit until, well, guess what? It's not. I think that's a sector we kind of handle in two ways. We have a fund that invests in banks. We let them do their thing. Hey, they managed to avoid the whole Silicon Valley Bank thing entirely. Good for them. They know what they're doing better than I do. We target a few preferred, like we have MBINL, perfectly solid bank. They had some earnings that were disappointing to common investors, and the preferred just kind of went down mostly in sympathy. We don't think it's the credit risk has increased. It's just the common investors are more bearish on the banks, and we get to pick up a preferred at a discounted price. So thank you. But yeah, that's not a huge part of what we target, but we look for those fringe opportunities. I think it's a sector that really requires that extra step of care to keep in mind that ultimately banks, the regulations protect the depositors, and that can sometimes be at the expense of people who are investing in the preferred or lending to the bank itself. So
I guess not surprisingly, we also like MBINL because we're kind of similar philosophies.
Well, great minds think alike.
So liquidity of ICAP and SCAP. Great news about those funds is RBC is our market maker. They make phenomenal markets. So you'll see that you get better. They post a lot of liquidity on both sides of the market. So there's a ton of underlying liquidity there. So you can trade that in size. And if you have any issues trading in size, you can contact us and we'll get you in touch with the market makers. But really great liquidity on those funds. And you can see it even on the tape. They posted on the tape. Jeff Bezos stated the surge of investment in AI is a kind of industrial bubble. What's your view? We have a totally non-consensus view on this. We think that when it comes to technology bubbles, they're fantastic. You need to have a bubble to attract the capital. Well, first of all, we don't really think we're in a bubble, but bubbles are good because you attract capital into the sector, like you're seeing it in the private market. sometimes at unsustainable valuations, but you get the capital in, you get the first to market. And so you end up with like the Mag 8, even though there was a lot of money wasted in 2001 on like Webvan and some other ridiculous investments. But you end up with all the leaders, the rest of the world is completely left out of the market. And so time to market's more important than efficiency to market. But we don't, there's some companies that are bubbles, like arguably Palantir, Tesla. But overall, with the companies we hold, like Broadcom, Amazon, and we have a little bit of tech in ICAP, they're trading at reasonable PEG ratios, so the P to the growth rate. So we don't see a bubble, but there will be a bubble, but that's an opportunity. So you might own Marvell at 90 and it's totally reasonable or undervalued on a PEG ratio. Well, maybe in 2 years it's going to be ridiculously valued. Well, that's good because you should probably sell part of your holdings, but it really creates an opportunity. Do you have any bubble thoughts, Will?
Now, I'm a little bit more bearish than you on that. I think something's got to give, but from our perspective, we're not really involved in the tech world because they're greedy, right? They're taking all the money and they're plowing it back into their CapEx. They're not giving very much of it out to shareholders. When they do, they tend to, do things like buy back stock and stuff, and that's not giving us the income we're looking for. From my perspective, I'm sitting there watching all of these data centers that are being built up. They're plowing all this CapEx into them. And I'm seeing infrastructure that ultimately infrastructure is going to be paying something around 5 to 8% returns on an unleveraged basis, right? That's just how infrastructure is. It doesn't matter what it is, whether it's telephone lines, the cell phone towers, and eventually this infrastructure is going to be a great opportunity for income investors to come in, provide the capital to buy them, and basically rent out I guess you'd call them AI units. And that's kind of I was talking about it this morning in our chat. Somebody was quoting somebody who was making a very similar point to what you were making. So I could be completely wrong on this, basically saying we're in 1996, not in 1999, right? That growth is still coming, and quite possibly, but eventually you're going to get to the point where the CapEx that they're spending, they have enough. AI is generating enough now that it's no longer a scarce commodity. You can no longer charge a lot for it. And then you start having that price run down to the bottom. We can't charge you $100 a month now for your 20,000 credits. It's going to cut down to $50 a month, and you're going to get in that kind of bidding war. And then you're just dealing with an infrastructure investment. Provide the capital, buy it from them, and sell the units and have that recurring income stream. And I think a lot of the companies that are applying this capital in, they're not necessarily going to be the big winners of the AI in the end because they're spending the money. But when it gets to the point where it's plentiful, other companies that are just starting out are going to come out, right? A lot of companies that become successful that are the big internet winners, they came out after the dot-com bust. There's a handful that were there before, like Amazon, kind of the exception that managed to get in there early and managed to survive through it. And I think that's kind of the route that it's going to go. I think the timeline predicting how long is a lot more complicated. And, we could be sitting with some decent growth here for a few years, or investors could have their faith shaken. And I think that's really what it is. It's when investors get their faith shaken and they decide to start selling out, it doesn't matter how good it is fundamentally at that point, the investors will just go until they become confident that AI can be monetized, that it can be producing the massive growth. The companies like Amazon that are still primarily generating money from other sources will obviously be perfectly fine. And if you can get them at a good valuation, I've held Amazon forever. So, yeah,
Okay.
they'll survive. They'll find ways to survive.
I'll tackle this one just quickly, and then the next question is great for you, Will. So it says, with AI, this is from Gerald, with AI replacing workers, couldn't one of the secondary effects be a reduction in payroll tax income to the government? Is there potential for this to accelerate budget deficits? So we're not concerned about AI destroying jobs. We think that it'll be just like the steam engine or every technological development since the beginning of the Industrial Revolution, in that you increase productivity, the return to capital increases, and investment drives, when companies invest, drives a need for more workers. So like a little bit of a simple example. So if you go to McDonald's, it is being automated because minimum wages are increasing. And so certainly there's some reduction in employment, not that much because you still have to make all the food. But McDonald's is continuously building new McDonald's. So because they're retaining earnings, making investments. So it's really investment that drives employment, not so much bad productivity. So you really want great productivity, great return on investment. This is what a lot of people like Keynesians we think have backwards. Like they think everything gets driven by demand, but we think it's really by investment. And that's borne out by the data, by the way. The IMF said every 10% increase in investment drives 1.5% more global growth by country. There's other studies that support the same dynamic. So I would look more at the amount of capital available. We think tariffs will provide more capital to be invested and we'll get better economic growth. So I would worry more about the investment side, and productivity is good for everybody, make higher incomes. Here's one that's directly in your bailiwick, Will. In your opinion, what is the driver for lower valuations on REITs, BDCs, and other dividend stocks we are seeing over the last week?
Well, I think we have to separate them, right? You can't just lump everything together. Because REITs, I think what we really saw with REITs in general is kind of a buy the rumor, sell the news type movement. That they all rallied nice going into the Fed meeting. Since the Fed meeting, they've kind of trended down. And I think that's just probably more technical factors than anything else in the short term. With BDCs, and you really start getting into like CLOs, I think there is some nervousness over credit. I think there's a segment of investors who are out there who believe that we are going to see a default spike, who believe that credit is going to start falling apart, and they're selling into that fear. And you can kind of see it with the CLOs. We have a couple CLO funds that we invest in. They've been trading at premiums forever, and now they're trading at a discount to NAV, which is something that just never happens. And then those kind of fears will start getting reinforced when the reality is they're investing in floating rate investments. Interest rates are coming down. That means that their cash flow is going down. And so that kind of becomes a self-feeding narrative that I think right now is in a lot of investors' heads. In the long term, you look at BDC prices, they were higher than ever in 2021 when interest rates were 0%. You get to that point where interest rates start getting so low that then suddenly people become hungry for yield. They're like, just give me 10% from anybody. I don't care who. And then you start seeing the higher yielding stocks start getting bid back up. And so that's kind of the longer term trend I expect to play out. But in the short term right now, with those BDCs and CLOs, we're seeing people be nervous about credit. We're seeing people thinking, well, interest rates are coming down and they're floating rates. And I think that's really a source of a lot of the selling pressure we see right now. With REITs, I think it's more just a pure technical move right now. And I think when you're looking at the 3-year charts a couple of years from now, you're not even going to notice the blip. It's just the stock market doing what the stock market does. And right now, the other day, we saw a good sell-off on REITs, especially mortgage REITs and equity REITs. And the only news that I could really tie it to was, okay, the 10-year yield popped up a little bit because traders were bored and there was no news coming out. And then it started correcting itself the next day. So I think that kind of turmoil is kind of normal whenever you're going through a period of change. Stock prices are volatile, and that's why I don't worry about them until I started working for Rita and people were asking me, why did the price do this? Why did the price do that? Honestly, I didn't even really notice what the price was doing because, well, for the most part, price changes don't change why I'm investing. I'm investing for the dividend. Earnings season comes along. I'm going through every page of the filings to make sure my dividend is safe. If it is, the rest of the market can do whatever the heck they want.
That's a good segue actually into the next question from Scott. If the S&P should drop by 25%, what beta do you expect the PFFA to have? Is the beta the same for 10, 25, or 50? So right now the beta is about 0.4 for PFFA, but it's a good point. When we have really disorderly markets, then the beta of everything, not just preferreds, but BDCs and utilities and everything that should actually be defensive, if people completely panic, it does matter. Like if the 10% just gradually occurs, then preferreds could have lower betas in the market. So like maybe preferreds could be down 2 or 3, markets down 10. It's completely disorderly, then everything goes to a beta of 1. But the real point here is exactly what Will said, which is it's actually a fantastic opportunity because it's completely irrational. We have the same philosophy. We're investing in full cycle companies. It's always proven to be the case that these drops are huge buying opportunities. But also I should say, I see the probability of a 25% drop being near 0. People have been asking, oh, well, just going to wait for normal 10% pullback and saying, well, good luck. When the Fed's cutting rates and got an AI boom going on, it's extremely unlikely. The only real chance is like just some completely out of the blue, like pandemic type situation. Otherwise, we're pretty confident in our targets. So I think that these low probability events are distracting and can really hurt your total returns, your long-term returns. If you're focused on like an asteroid destroying North America, it's better to assume kind of the most likely case. But if it does drop, huge buying opportunity, in my opinion. Liquidity of our funds in relationship to volume. There's these great market makers. RBC is involved in most of our funds. So you could say the liquidity, oh, it's not that fantastic. Like we actually had a really big buyer of PFFA. And then keep in mind that trades like 500,000 shares a day. And they wanted to buy 20 million. And we said, look, don't just look at the volume. Look at what the market makers will do. And they went and bought, I think 400,000 shares, a few pennies above NAV. They did it with the market makers. So tons of underlying liquidity, and particularly with preferred, like you can't go buy like $15 million of one preferred issue, completely blow up the market. But you can with PFFA, and it's because of the market makers. Here's a question about tariffs. Somebody's saying they're a huge fan. We believe in modest tariffs because it's done by the president and the administration. Congress will never pass any taxes increases, at least this Congress. And they're never going to significantly cut expenses expenses or expenditures. So the only way to do it is have a unilateral approach. And, there's some winners and losers, as this question implies. So maybe there's some crop impacts. One thing to keep in mind about commodities is if you don't sell it to China, you can sell it to somebody else, and then whoever you sell it to doesn't buy it from China or send it to China. So I wouldn't be too concerned about that, but it's a political issue, so there may be some payoffs to the agricultural interests. Why don't you maybe tackle this one, Will? Yeah. Is there a difference between yield and total return? You mentioned 9 to 10% yield. Is that in addition to appreciation in stocks?
Generally speaking, historically, our CAGR has been floating right around that 9% since HDO was founded in 2016. And it actually ended up being slightly higher than the actual dividend yield. But in general, the types of investments that we're buying are designed to produce dividends. There's no magic bullet where, oh, hey, I'm going to get a price that's going to keep up with the S&P 500 and pay me a 10% dividend on top. Occasionally you'll find that opportunity, right? Occasionally there's that stock that just crashes down, loses so much money, and then it has a recovery. You can get those kinds of returns. But in general, in a stable environment, when you're buying things that are more or less at fair value, you can expect that substantially all of your returns will come as dividends. In some cases, like with RICs, regulated investment companies, include BDCs, REITs, they're required by tax law to distribute all of their taxable income. So what you're getting is essentially all of the money that the company's making. That's why it has a high yield, right? And so they're not designed to retain capital, to reinvest capital and keep growing, which is what would drive the price higher. They're generally designed to distribute that money to you. If you want your capital to grow, reinvest a portion of it. Our default is to suggest planning on reinvesting about 25% so that you can have that capital growth going throughout your portfolio. But in the very long run, if you have an 8 to 10% yielding portfolio, in the very long run, the S&P 500, 8 to 10% is a pretty reasonable return range to get over 10, 15, 20, 30 years. And you're going to end up with roughly the same return. I would say our portfolio tends to be closer to like the Russell 1000 value index. And that's because any stock that's paying out 8 to 10% yields is a value stock by definition. So our portfolio is going to outperform when value stocks are outperforming growth. We're going to underperform when value stocks are underperforming growth. There's ways you can get exposure to growth through like funds and stuff that can help change that a little bit. But yeah, overall, we're targeting that 8 to 10% because we believe that's an amount that's sustainable, that we can routinely keep getting from the market without being overly greedy, without stretching too far, without taking on too much risk. And the vast majority of your returns are going to come as cash coming into your account. What you do with the cash after that is completely up to you. If you reinvest a lot of it, that big number on your account is going to go up faster. If you're taking it all out and going out and having a good time with it, well, then your account value is going to be more towards that stable-ish side.
Okay. But this is good news because we have a passel of questions here for you, Will, because we want to hear from other people besides me. So 2 questions on BDCs are basically related. Is there going to be significant dividend cuts, and are the prices going to continue to drop for that reason?
BDCs, at least the ones we own, have all taken on the practice of setting a stable dividend and then paying what they call a supplemental dividend. And those supplemental dividends were put in place because interest rates were high. It's important to keep in perspective that it isn't so much whether interest rates are high or low that matters. It's the movement in rates that BDCs benefit from, right? Because they own floating rate assets, they borrow fixed rate debt. And so they hit that situation where the debt was fixed, but then the floating rate started climbing up really fast. Well, the fixed rate debt down here didn't have to be refinanced for 5 years. So they're benefiting from this difference right here. And that's where the supplements are coming in. Now you're seeing a combination of they're starting to have to refinance some of that debt. They're starting to have to refinance some of that debt at current rates. Well, the floating rate is starting to come down. And they're going to get back into that normal range where they're just back to earning a normal spread. I think if you look at most BDCs and you see what they were paying out in 2021, that's probably where they're headed to. There are a few of them that have managed to raise capital and actually grow their asset base, become more efficient with economies of scale, and they'll pay a little bit higher dividends. But anything that's being labeled as a supplement right now, that's management telling you this is temporary. Now, the positive side is that when we get into a new environment, especially if the economy is doing okay, when interest rates get lower, we're going to start seeing more companies IPO. BDCs in general usually own some equity in the companies. And so you'll start seeing more cases where that equity is being monetized because the companies they own are being bought out by competitors. They're being IPO'd. And that will result in what we saw, back in the 2016 to 2019, and where you start seeing these big monetizations, and then back then they labeled them as special dividends, right? It's very lumpy, it's very inconsistent. You don't know what it's going to be, but they'll have a equity that gets monetized, and they'll have a big tax obligation, so they have a big special dividend, large relative to their stock price. And so eventually, when we have a strong economy and that's happening, we'll start seeing those dividends come up. But you won't necessarily see the quarterly regular supplement we're seeing today. If you're buying a BDC today, I would look at what their regular dividend is. That's what I would expect to get, to the extent that you keep getting the supplements for another year or two. That's just a bonus on top. Share price is a different beast. Just because what a company is paying goes down does not necessarily cause the price to go down. You'll often see a movement in the initial reaction, but like I mentioned before, if you look at most BDCs, their peak price was in 2021 when they were paying no special dividends, they were paying no supplemental dividends, they were only paying the base, and they were at a peak price. And that's just because investors were so hungry for yield, and those regular dividends are still a very nice return.
I think we'll have to rename this the BDC webinar. So what do you think about OXLC? Well, from Steve.
All right, OXLC, they're a company that invests in CLO equity almost purely. And CLO equity is an asset class that really confuses a lot of people. CLO is kind of its own little independent company that goes out there and buys up a lot of syndicated loans. These are loans that are issued by banks to corporations. If you're looking at a corporate balance sheet, it's usually going to be labeled as something like a term loan or something like that. They're floating rate loans. The banks make the loans, and then they, thanks to banking regulations, they sell them off. And the CLOs buy up these loans and then they break off the payments, right? If you're willing to pay a premium, you get to be in the senior tranches, the senior debt tranches, and you're getting a fixed return, and you're getting you have a fixed amount of par value, I should say, and you're being paid an interest rate on that. And that's usually very low. And then you get down to the junior debt tranches, the interest rate's a little bit higher, but again, you're being repaid a certain amount of par. You get down to the equity and you're getting whatever's left. It's the highest risk position. It's also the highest cash flow position, because the people who are in the senior debt levels are getting an interest rate that would be lower than what the borrower is actually paying. And all that excess goes down to the equity. The idea being that the equity is also the one that eats the first loss. So with the CLO equity, it really comes down to, is the cash flow high enough to offset whatever credit losses we're going to realize? Historically, the answer to that has been yes. Even through the great financial crisis, the CLO equity outperformed the senior debt tranches in terms of total return. Now, it's not always going to be a smooth ride. CLOs have various covenants and stuff that can restrict the cash flow to the equity during times of turmoil. We saw that in 2020, and that's why they slashed their dividend in half. All that extra money was then going and being sent along to repay the senior lenders until the covenants got into line and they could start paying the equity again. And so you're dealing with that risk, but ultimately it comes down to a question of how many defaults do you think we're going to see? Are the defaults going to be greater or less? Is the 25% cash yield that they're getting going to be substantial enough to offset that? My answer is yes. As I said earlier, I don't see the credit environment as overly stretched. I certainly don't see it as anything like we saw going into the great financial crisis. I think balance sheets are in general much stronger, and CLOs are dealing in that B plus credit range that I think is very attractive right now. And so I'm very bullish on the sector. It is going to be volatile, but right now investors are getting nervous. OXLC is trading at a discount to NAV, which hasn't happened since 2020. They've already sold off. They're already trading at a discount. Investors are already nervous. And I think that's an opportunity to buy at a very attractive price. I think any investment in this sector needs to be made with the understanding that, yes, you're getting a 20% plus yield because there is credit risk there. They are going to have some credit losses. It's just a question of what that credit loss will be. But 20% plus is a really good starting point to start absorbing credit losses, right? That's why your credit card charges a 20% interest rate, because they know not everybody's paying it back. They make the profit because 10% is enough to offset all the people who choose or are unable to pay back their credit card.
I'll tackle this real quick, and then I have a couple of questions about your business. Well, so BHF, we actually like this BHF situation. They might get taken out, We think the credit's still going to be good if they get taken out. It's a regulated insurance company. So we have been buying all of their preferreds. And this is a question about the bonds, but is there a safer way to do it? And so we're positive on all those, even if they get taken out, or really assuming they're going to get taken out. But you have the additional upside that the equity's trading like they're not going to be taken out. I don't necessarily agree with that, but there's clearly the equity's signaling there's some probability they won't, pretty significant probability they won't get taken out. So then it's just phenomenal because they're yielding like 10. So we're bullish on that and continue to add to that. 2 questions about your business, Will. Do you have a portfolio or list of evaluated investment opportunities? I think I know the answer, but you can tackle that. And how do you directly contact HDO?
Yeah, on Seeking Alpha, we have, for our premium members, we have what we call a model portfolio. It's a spreadsheet that typically we have somewhere between 120 to 140 investments among all 3 branches. We got our funds, we have our fixed income, and we have our individual stock picks. And we maintain that meticulously. We provide not only our buy unders on it and provide regular updates on those stocks. Every week we're producing 2 articles that are focused on nothing but calling out tickers that have had news or that we think are particularly good opportunities. And we also provide links to all the tax data. We try to table everything so that you can find the best information about those stocks on one spreadsheet that you can get anywhere.
And here's a related question. So do you offer any subscriptions outside of Seeking Alpha?
Yeah, we have a sister service, Elliott Wave Trader. We're a high dividend investing over there. That's a sister service that we set up that runs alongside of it. And then we have Seeking Alpha is the mothership. And if you go to like incomemethod.com, that's where we offer a lot of our free stuff. It's not going to be as in-depth, but you can get that, you can read it and see what we do, see what we're writing about before you want to dip your toes in and start paying for the premium service. You had another question that was in there. I don't remember what it was.
Okay. And let's see. Sorry, I was getting ahead of us. Oh, here's sort of a somewhat amusing question about my personal holdings in PFFA. And they are confusing. I'll admit this. So it's actually dropping slightly over time because we get so much income and I buy other securities. But PFFA is roughly 75% of my IRA, which is not completely trivial amount of money because I've been around for 35 years. So compounding works. And then it is 3, and don't do this at home. Absolutely do not do this at home. It's 300% of my personal account. So I have a levered 3-to-1. Absolutely do not do that. Keep in mind that we also have a hedge fund where I have a lot of capital. So I can inject capital into my individual account if it did have a margin call. And so that's why you shouldn't do that at home, is I have backup funds to fund a margin call. But that is accurate depiction, and it's done really well, but no guarantees and not a good long-term investment strategy. But it's a good example. Like a lot of times I say, well, we keep our investments in certain companies, to 3 to 5% because we don't run the companies. Well, we run PFFA, so I'm comfortable like being all in on it, but don't do that at home. So it's a little bit funny because it's like sort of ridiculous. But what about, Will, do you have any views on royalty companies?
We love royalty companies. That's included in the, I kind of lump them in my head in with MLPs. I know they're not exactly the same, but I'm not the energy guy. I don't make the energy recommendations for HDO. That's one of the benefits of having a team, right? Not everybody's expert on absolutely everything. And I know that's one of the sectors I'm not an expert on. So we have Venkat, his screen name's Hidden Opportunities. He does a lot of our due diligence on royalty companies. We've had a couple of them. I think we have one in our portfolio right now. We had another one that we ended up exiting because the market was so inconsiderate. They offered us such a high price, we had to exit it. And that's always known when that happens. So yeah, it's definitely a sector that we watch. We have holdings in them from time to time. It's cash flow. And we're all about identifying those areas of cash flow and we have a meeting between us whenever we're looking at adding something to the portfolio. Everybody makes their pitch and we fight with each other behind the scenes about it and do our due diligence and pick those out. If you're looking for intelligent commentary on royalty companies, you want to talk to Venkat, Hidden Opportunities. He's forgotten way more about it than I will ever learn. So
I guess thankfully for you folks, I forgot to turn my camera on, but I looked through all the other questions and a lot of them have at least mostly been covered and we're going super long. There is a question about PFFA dividend. We cut it during the COVID. We changed our approach strategy. So we no longer have any common stock. We don't write covered calls. So we reduced it to reflect that more conservative strategy. But now our objective is to always increase it very slowly. The way we do that is by selling high, buying low. So we look at it as our report card. We do have the tailwind. Lower rates means we borrow lower costs, gives us more distributable income. So that's certainly the goal there. And somebody couldn't find the return information. You can send us an email. It's absolutely there for our funds, but.
Sorry to distract you here, Jay, but this is one of the most frequent questions that I get is people always want to talk about the expense ratio. And, you're an actively managed fund with PFFA, you got a little bit of leverage in there. And so naturally the expense ratio is going to be a little bit higher than it is for some of your competitors who aren't leveraged and aren't actively managed. And when you look at it, just the price you're saving on the leverage compared to what you would pay for it yourself is often way more than the expense ratio, and you get that active management. And that's one of the reasons why we favor closed-end funds over ETFs is because you get a good manager and it more than pays for itself. You get that cheap access to the leverage. Do you want to make more money or do you want to pay a lower expense ratio? I guess that's your choice, right?
Yeah. So, and also when we quote our fees, well, there is this distractor that there's a 2.5 number, but that's misleading because you're showing the expense, but not the revenue we get from investing that borrowed money. And then every time we quote, or if you look on our website, fees, keep in mind that we've paid for them by substantially, like almost doubling the return of PFF. So that's why we sit in our offices every once in a while. We answer questions from clients like we're doing now, but otherwise we're just grinding on these portfolios, selling above par, buying below par, analyzing VHF, finding opportunities. Then or like Will was mentioning, the TDSs, then they trade up and we sell them. So it's pretty tedious, but highly effective. And we've been able to less kind of ridiculously cover those fees. So particularly with fixed income, you want to have active management. So we are 100% available. You can either call us or feed us questions through the websites. If somebody still can't find the returns, they can just email us directly. Will's probably the same. And we do recommend his service for finding other investment opportunities beyond our funds because we're not going to be like recommending BDCs and all these other asset classes. So it's a great service. And Will, thank you for joining us. Great answers to a lot of questions, great questions. So really successful webinar in my opinion. So thanks to everyone.
All right. Thanks, Dave, for having me. And thanks everybody for tuning in and watching.
Great. All right. See you next month. Thanks, Will.